I need you to look at one number, not the silver price, not the gold price, not the jobs report that just came out this morning. One number that sits between those two prices. A ratio that most investors in this market have heard of, but very few actually track with the precision it deserves. Because this number, right now, on Friday, May 8th, 2026, just moved in a way that has historically been one of the most reliable early warning signals of an explosive silver run that this market has ever produced. The gold-silver ratio is sitting at 58.74 today, down from 59.79 just yesterday, down from 61.5 earlier this week, down from the elevated levels near 63 that we were tracking when silver was being crushed by the war discount at $73. In 1 week, 7 trading days, this ratio has compressed by more than 4 full points. And I need you to understand what 4 points of compression in the gold-silver ratio means historically, because the number 58.74 is not just a statistic. It is a position on a map. And the map has a very specific destination that every investor who has studied the history of this market knows well. Today is Friday, May 8th, 2026. Asian guy here. Silver is trading at $80.29, up 2.44% today, up nearly 7% on the week, up 12.95% year to date. Gold is above $4,720, heading for a weekly gain of over 2%, its highest level since April 22nd. Brent crude has dropped more than 7% in 5 days, breaking below $100 per barrel for the first time since the Iran conflict began. The jobs report this morning showed 115,000 jobs added, surpassing expectations of 62,000. And Iran's response to the White House peace proposal is expected this weekend. Every single one of those data points matters, but none of them matters as much as the ratio. Because the ratio is the instrument that tells you not just where gold and silver are today, but where they are relative to each other. And more importantly, where that relationship has historically gone from the specific position it is in right now. And from 58.74, with a week of compression already behind it, and every structural driver we have discussed over the past 2 weeks still intact and in most cases strengthening, the historical map has a very clear answer about what comes next. Let me show you the engine. Because the prices on your screen are the exhaust, and the ratio is the compression gauge on the engine. And right now, that gauge is reading something that every serious precious metals investor needs to see. Let me start with the ratio itself because I want to be precise about what it is, what it measures, and why the specific level of 58.74 is significant in the context of where this market has been and where it historically goes from here. The gold-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. At 58.74, you need 58.74 ounces of silver to equal the value of 1 ounce of gold. At 61.5, where the ratio was earlier this week, you needed 61.5 ounces. That 2.76 point compression in a single week represents silver gaining ground on gold at a pace that, when sustained and accelerated, produces some of the most dramatic price appreciation in any asset class in the world. Now let me put 58.74 in historical context because without the history, the number means nothing. For the majority of recorded monetary history, centuries of silver and gold circulating as actual currency in global trade, the ratio traded between 15 and 20 to 1. That was the organic, market-discovered relationship between these two metals when physical supply and physical demand set the price without the distortion of a derivatives market layered on top. In the modern era, since the COMEX futures market took over price discovery in the mid-1970s, the ratio has averaged approximately 60 to 1 over long periods. It spikes during financial crises and risk-off events. It spiked to 125 to 1 during the COVID panic of March 2020, the most extreme reading in modern history, representing silver at maximum distress relative to gold. And it compresses during precious metals bull markets, when silver's unique combination of monetary and industrial demand drives it to outperform gold dramatically on the percentage basis that the ratio measures. During the 1979 to 1980 bull cycle, the ratio compressed from approximately 40 to 1 all the way down to 17 to 1 as silver went from $9 to $50. During the 2010 to 2011 cycle, the ratio compressed from approximately 65 to 1 down to 32 to 1, as silver went from $18 to $49. In this current cycle, the ratio peaked at elevated levels during the mid-cycle correction and the war-driven sell-off, sitting above 63 to 1 when silver was at $73 just 2 weeks ago. And now, in 7 trading days, it has compressed to 58.74. Here's the critical point. We are not at 58.74 because the fundamental story has played out. We are at 58.74 because the war discount has begun to close. Because oil dropping 7% in 5 days has removed some of the inflation fear that was suppressing silver's industrial demand component. Because the Iran peace proposal moving through Pakistani mediators has begun to reduce the geopolitical risk premium that was keeping institutional investors underweight precious metals. Because managed money funds that were sitting on historically low silver long exposure are beginning to rebuild their positions as the price moves in their direction. The compression from 63 to 58.74 is the beginning of the move, not the middle, not the end, the beginning. And the historical record, 17 to 1 in 1980, 32 to 1 in 2011, tells you that from 58.74, with the structural drivers we have been discussing for the past 2 weeks all intact and strengthening, the runway on this compression trade is significant, dramatically significant. And the investors who understand what the compression from 63 to 58.74 in 1 week is signaling are the investors who are positioned for the full move, rather than chasing it from wherever the ratio is when the mainstream financial press finally decides to cover it. Now let me walk you through exactly what drove the ratio from 63 to 58.74 this week, because understanding the mechanism is essential for evaluating whether this compression is durable or whether it is a 1-week bounce that reverses when the next negative headline hits. The first catalyst is the oil collapse. Brent crude dropped more than 7% in 5 trading days, from above $112 to just below $100. That is not a routine price fluctuation. That is a significant repricing of the energy supply risk premium that the Iran conflict had built into every barrel of oil traded globally. And the mechanism by which a 7% oil drop benefits silver specifically, more than it benefits gold, is the war discount concept we introduced earlier this week. The war discount on silver had 3 components. The first was energy inflation driving rate hike fears and suppressing rate cut expectations. When oil drops 7% in a week, headline inflation expectations drop with it. The rate hike narrative that was driving institutional silver selling weakens. The industrial demand discount that was being applied to silver because of recession fears linked to energy costs partially reverses. Oil falling from $112 to below $100 does not close the entire war discount on silver, but it closes the first and most mechanically direct component. And when the first component closes, silver outperforms gold because silver had the larger war discount to begin with, meaning the same amount of war discount reversal produces a larger percentage gain in silver than in gold. That is why silver is up 7% on the week and gold is up only 2.25%. The asymmetric war discount is closing asymmetrically. The second catalyst is the Iran peace process structure. The U.S. sent a 1-page memorandum of understanding through Pakistani mediators. Tehran confirmed it is reviewing the proposal. Iran's response is expected this weekend. I want to be very precise here about why this specific structure, a formal written MOU transmitted through a third-party mediator, is categorically different from the previous de-escalation signals that produced brief rallies before failing. The ceasefire a month ago was an operational pause. No written document, no third-party mechanism, no verified compliance framework. Project Freedom was a unilateral U.S. logistics initiative, not a bilateral agreement. The MOU transmitted through Pakistan this week is a formal diplomatic instrument. It has a written record. It has a third-party transmission mechanism that creates accountability for both sides. Tehran responding through the same channel creates a bilateral negotiating framework that the previous signals entirely lacked. The market is beginning to price the difference between operational pauses and formal diplomatic frameworks. And that repricing, the upgrade in probability that a real deal gets done, is the second component closing the war discount on silver. The third catalyst is the jobs report. 115,000 jobs added against expectations of 62,000, nearly double the forecast. And here is why a strong jobs report is bullish for silver right now, even though the conventional wisdom says strong jobs equals higher rates equals pressure on precious metals. The conventional wisdom is wrong for this specific market configuration. A strong jobs report in an environment where the Iran peace process is advancing means the Fed has the flexibility to cut rates when the energy supply shock resolves, because the labor market is strong enough to absorb a cut without overheating the economy. In other words, a strong jobs number combined with oil falling below $100 gives the Fed a path to rate cuts that did not exist 2 weeks ago when oil was at $112 and inflation was accelerating. The market is reading the jobs report through the lens of the Iran de-escalation, and in that context, A strong economy plus falling oil prices plus an advancing peace process is the most bullish possible macro backdrop for silver. Three catalysts, each one closing a different component of the war discount that has been suppressing silver, each one happening simultaneously in the same week, and the ratio moving from 63 to 58.74 in 7 trading days is the mathematical expression of those three catalysts working together. Now let me take you through the historical record, because the ratio breaking below 60 is not just psychologically significant. It is a level that, in previous cycles, has marked the transition from the early compression phase to the accelerating compression phase. And the accelerating compression phase is where the dramatic price moves happen. In the 2010 to 2011 cycle, the ratio was trading in the mid-60s in August 2010, elevated relative to historical norms. Silver recovering from the financial crisis correction, but still significantly underperforming gold. The ratio broke below 60 in October 2010. From that moment of breaking below 60 to the eventual low of 32 to 1 in April 2011, 7 months, silver went from approximately $24 to $49, a 104% gain in 7 months, in a metal that had already been in a bull market for 2 years before the ratio broke below 60. The break below 60 was not the end of the story. It was the beginning of the most explosive chapter. In the 1979 to 1980 cycle, the dynamics were even more dramatic. The ratio was in the high 30s when silver was at $9 in mid-1979. It broke below previous support levels as silver began its parabolic run. The compression from 40 to 1 to 17 to 1 happened in approximately 5 months, as silver went from $9 to $50. Now look at where we are. The ratio just broke below 60. From 61.5 at the start of this week to 58.74 today. That break is happening in an environment where the fundamental drivers are stronger than they were at the equivalent point in either the 1979 or 2010 cycles. In 1979 and 2010, silver did not have the AI infrastructure CapEx demand wave adding a new, unprecedented industrial demand stream. In 1979 and 2010, global solar deployment was not requiring millions of ounces of silver paste per year at an accelerating pace. In 1979 and 2010, the gold-silver ratio was not breaking below 60, while simultaneously a peace deal that could remove a war-driven supply discount was being negotiated and expected to be responded to within 48 hours. The historical playbook says that when the ratio breaks below 60 in a bull market, when it crosses that threshold with fundamental buying pressure, managed money repositioning, and macro tailwinds all aligned, what comes next is not a consolidation back above 60. What comes next is an acceleration of the compression toward the 40s and eventually the 30s. Not in a straight line, not without corrections and volatility along the way, but directionally, persistently, with a destination that makes 58.74 look like the starting line rather than the finish. Let me address the weekend directly because it is the most time-sensitive element of today's setup, and every investor holding silver or gold right now needs to understand the binary that is sitting in front of them before markets close today. Iran's response to the White House MOU is expected this weekend. Tehran is expected to respond through Pakistan within the next 2 days. That means by the time markets open on Monday morning, by the time the COMEX silver futures pit opens, and the first trades of the new week are being placed, the market will either know that Iran has accepted the framework and peace negotiations are formally underway, or it will know that Iran has rejected the MOU and the conflict is entering a new phase of escalation. Let me walk you through both scenarios because the asymmetry between them is the most important thing I can tell you today. Scenario 1. Iran accepts the MOU. This is not a full peace deal. More comprehensive negotiations over the nuclear program are reportedly expected later. But an acceptance of the MOU framework means the Strait of Hormuz begins a phased reopening. Oil drops sharply, the market was partially pricing in continued disruption, and a formal peace framework triggers immediate selling of the risk premium built into every barrel. Oil going from below $100 toward $80, a level consistent with pre-war supply and demand, removes the last component of the war discount that has been suppressing silver. The rate hike narrative disappears. Rate cut expectations return fully. The dollar weakens. Managed money floods back into silver long positions. The ratio breaks below 55 in days, and silver, which has already moved from $73 to $80 on the war discount beginning to close, accelerates toward the levels that Bank of America's $86 target describes, and then beyond them as the fundamental demand wave that has been building underneath the war-driven suppression is fully released. Scenario 2. Iran rejects the MOU or fails to respond by the weekend. Oil recovers toward $110. The war discount on silver reasserts itself. Silver gives back some of this week's gains. The ratio moves back towards 61 or 62, and the compression trade that just fired pauses. Not reverses structurally, but pauses, while the diplomatic process continues. Here is the asymmetry. In scenario 1, the upside for silver from current levels is dramatically larger than the downside in scenario 2. The war discount has already partially closed. Oil is below $100. The ratio has already compressed from 63 to 58.74. Silver has already moved from $73 to $80. A rejection of the MOU does not take silver back to $73 because the physical supply-demand fundamentals that built this move are not dependent on the Iran peace process. They are the independent foundation underneath the war discount. The downside in a rejection scenario is a partial reversal of the war discount closing trade. The upside in an acceptance scenario is the full closure of the war discount plus the release of the fundamental pressure that has been building for 12 weeks. That is not a symmetric bet. It is an asymmetric setup with significantly more upside than downside from today's entry point. Let me close by putting the full picture together because I want you to leave this video with a complete framework, not just for today, not just for this weekend's Iran response, but for the next 6 to 12 months of this precious metals bull market. Silver is at $80.29. Gold is at $4,720. The ratio is at 58.74. Brent crude is below $100 for the first time since the war began. The jobs report showed a strong economy that gives the Fed flexibility to cut when the energy shock resolves. The Iran peace process is at its most advanced stage since the conflict began, with a formal MOU transmitted and a response expected within 48 hours. And the fundamental supply-demand picture, the supply deficit, the AI CapEx demand wave, the solar build-out, the sovereign accumulation, is intact, and in most cases, stronger than it was when this series of videos began 2 weeks ago. From this position, ratio at 58.74 with all of these forces aligned, the historical map says the compression continues. The 50s become the 40s. The 40s become the 30s. Not overnight, not in a straight line, but with the persistence and eventual velocity that has characterized every previous major ratio compression in the modern era. What does a ratio in the 30s mean for silver at current gold prices? If gold holds at $4,720 and the ratio compresses to 40-1, a conservative target, still well above the 32-1 low of the 2011 cycle, silver would need to be at $118 per ounce to make that math work. If gold moves toward Bank of America's $6,000 target and the ratio compresses to 40-1, silver is at $150. If the ratio compresses toward the 30s, as it did in 2011, the implied silver price at various gold levels becomes a number that most investors watching $80 silver today would describe as impossible, just as most investors watching $18 silver in August 2010 would have described $49 silver by April 2011 as impossible. The ratio does not care about what seems impossible. It cares about the supply-demand forces driving it. And those forces right now are pointing in one direction. The compression signal just fired. The ratio broke below 60. The historical playbook is clear. The fundamental drivers are aligned. The Iran peace process is at its most critical 48-hour window, and silver is at $80, still 15% below where it was before the war started, still carrying a war discount that is in the process of closing, still significantly undervalued relative to where the ratio compression trade takes it when the full fundamental pressure is released. The investors who understand what the ratio is telling them right now, who can read 58.74 not as a number, but as a position on a map with a very specific historical destination, are the investors who are going to capture the most explosive phase of this silver bull market. The phase that the mainstream financial press has not yet described. The phase that the managed money funds have not yet fully positioned for. The phase that the ratio, dropping from 63 to 58.74 in a single week, is telling you has just begun. This is Asian Guy. If this breakdown gave you a framework for reading the gold-silver ratio that the spot price chart alone cannot give you, a way to see where we are in the compression cycle, what the historical playbook says about what comes next, and what this weekend's Iran response means for Monday's market open, like this video and share it with one person who is watching silver at $80 and wondering whether the easy money is already made. The ratio says it is not. The compression has just begun. And the destination on this map is a number that makes $80 look like the opening sentence of a story that has many chapters yet to be written. The signal just fired. Do not wait for the headline to confirm what the ratio is already telling you.